All right, if you're a crypto investor, you're going to want to pay close attention. The way you handle your taxes is about to get a major overhaul, and it all centers on this brand new form, the 1099-DA. For years, crypto taxes have been, well, kind of like the Wild West, right? A confusing, self-policed frontier. But those days, they're officially coming to an end. The IRS is rolling out a much more structured system, so let's break down exactly what this is all going to mean for you.
So here's our game plan. We'll kick things off with the new form itself, then figure out who this really affects. After that, we'll dive into the new rules for tracking your basis, lay out a clear action plan for 2025, and finally, take a peek at what's on the horizon.
Okay, first up, let's get to know the star of the show, this new crypto tax form.
So this is it, Form 1099-DA. The DA, as you can probably guess, stands for Digital Asset. Now, the easiest way to wrap your head around this is to think of it just like the Form 1099-B you get for your stocks. It's basically the crypto version of that, designed to report your transaction proceeds to both you and the IRS.
Now, let's talk timeline because this isn't all happening at once. The new rules officially kick in on January 1st, 2025. And for that first year, so the 2025 tax year, your broker is only going to report your gross proceeds. That's just the total amount of money you got from a sale. But then, starting January 1st, 2026, things get more detailed. They'll also have to report your cost basis, which will make calculating your actual gains or losses way more straightforward.
So this brings us to the million-dollar question, right? Who does this actually affect? If you're holding crypto, is this something you need to be worried about?
The new rules draw a really clear line in the sand. It all comes down to custodial versus non-custodial. So this applies to what are called custodial brokers. Basically, any platform that holds your private keys for you. We're talking the big centralized exchanges like Coinbase and Binance, or those hosted custodial wallets. But, and this is a big but, if you're mostly in the DeFi world using decentralized exchanges like Uniswap, or you have a self-hosted wallet where you and only you control the keys, then for now, you're in the clear. These reporting rules do not apply.
All right, this next part is a really big deal. This is where the new rules are going to fundamentally change how you manage your crypto portfolio on a day-to-day basis. So think about the old way we did things. It was a universal approach. You could basically treat all of your Bitcoin, for example, no matter which wallet or exchange it was on, as one giant pool for tax purposes. It was, way simpler.
Well, that's over. Gone. The newer regulations demand a wallet-by-wallet approach. This means you now have to track the cost basis of your assets inside each specific wallet or account where they're held. No more mixing and matching bases from your whole portfolio. That's a huge shift. And hey, just a super quick refresher here. Your cost basis is just the original price you paid for your crypto plus any fees. It's that simple formula. Gross proceeds minus your cost basis equals your gain or your loss. And that last number, that's what the IRS is really interested in.
Okay, so how do you know which specific coins you sold? Well, the default method is called FIFO, or first in, first out. The first coins you bought are the first ones considered sold. It's simple, but yeah, in a bull market, it can lead to higher taxes. The other option is specific ID, where you get to pick the exact units you want to sell, usually to lower your tax bill. But here is the massive change. You can't just figure this out when you're doing your taxes anymore. You now have to tell your broker which units you're selling at or before the time of the sale. That is a game changer. Okay, wow, that's a lot of new information. So let's get practical. What do you actually need to do about all this right now, this year? This right here, this quote, it really hits the nail on the head for your main homework assignment for 2025. Because of that new wallet-by-wallet rule, you've got to go back and officially assign your historical cost basis to the specific accounts where your crypto lives today.
So how do you do that? Let's break it down into 3 steps. Step 1, get a full inventory of all your crypto holdings across every single account. Step 2, calculate your total unused cost basis for each type of crypto you own. And step 3, and this is the important one, by December 31st, 2025, you need to assign that basis to your specific wallets using what they call a reasonable method. That could mean assigning specific units, or maybe just allocating it proportionally.
Now, here's a little bit of good news. The IRS gets that a lot of brokers might not have their systems ready for all this on day one. So they've actually given us all a bit of helpful breathing room just for 2025. It's a special 1-year relief rule, and here's how it works.
If your broker can't yet process your specific ID instructions when you make a sale in 2025, you can still use it. You just have to document your choice in your own records. You could identify the specific units for each sale, or you could even set a standing order for the year, like always use HIFO, highest in, first out. But, and this is key, remember, this relief is for 1 year only. It ends January 1st, 2026. So we've seen how the centralized platforms are being brought into the traditional tax system, which naturally leads to the question, what about the rest of the crypto universe? What's next?
Well, it's actually a pretty interesting little story. The IRS did try to regulate DeFi. They actually issued rules that would have brought reporting requirements to some DeFi transactions. But there was a huge pushback, and in response, Congress actually stepped in and passed a resolution to block those new rules. And the results? For the foreseeable future, there will be no IRS reporting requirements for DeFi. So for now, that line between the custodial world and the DeFi world remains very, very clear. All right, let's wrap this up with the key takeaways you absolutely need to remember. First, the new Form 1099-DA is coming for the 2025 tax year. Second, this only applies to custodial brokers like Coinbase, not DeFi. Third, for 2025, brokers will only report gross proceeds, but they'll add cost basis starting in 2026. Fourth, and this is a big one, you have to track your crypto basis on a wallet-by-wallet basis now. And fifth, FIFO is the default method, unless you use specific ID, and remember you have that special relief rule just for 2025.
And we've got to give a huge shout out to the Bradford Tax Institute. Their incredible research is what made this whole explainer possible.
You know, these new rules are obviously a huge step towards integrating crypto into the traditional financial system. And it leaves you with a really big question, doesn't it? As crypto becomes more and more a part of the mainstream, what does that mean for its future and for that original rebellious spirit of decentralization it was founded on?